I think most important is going to be everyone just being really comfortable with what a straddle is. And I think this might be review for most, but just to go over, whenever you do a straddle is just a great way to get a measure of the volatility that's in the market. So straddle, whenever we see a straddle, we'll start at the top right, stock price 40. This should be 40 strike and 40 strike puts. If they're 250 each, the straddle would be $5. And so what a lot of times I'll say, there's a 10% straddle or 15% straddle. This is all I'm referring to. The $5 is 12.5% of 40. And then this little chart is just showing us exactly the break-even points of the straddle. If we put it on, if we bought the calls and bought the puts, our max loss would be $5, and then we would need it to get under 35 or over 45 in order for us to profit. If we sold the straddle, we'd want everything just to be quiet. We'd be short volatility. When you're short volatility, you just want no movement. You want everything to be super, super quiet. Over here, long straddle, buy a call, buy a put, we're long the straddle. We're expecting movement, we're expecting volatility. Upside, unlimited. The stock could go to 4,000, I guess. And our downside is whatever we pay for the straddle. And time passing hurts. We want as much time as we can. Every day that goes by where our straddle doesn't move is hurting our position. Now volatility. Two examples here. I just took Apple and Chipotle. Both 5 days to expiration. So these are the weeklies. 5 days, 5 days. So the exact same amount of time until expiration. And we can see Apple, the 119 straddle, is about 225. So about, what's that, 120 and whatever the math was. I guess I used $1.30 and 95. So that would be 225, 1.9% straddle, 2.5% straddle on Apple. But then we look at Chipotle, and Chipotle is dealing with some news issues. Their stock's been getting crushed because of supposedly they're serving some bad food over there. But we see the volatility on Chipotle is 6%. So we can see the difference in options pricing. Whenever I look at a stock that's $535 or a stock that's $5.35, you could just make that stock $53. Okay? You don't have to look at it so it's $5.35. If you make it $53.50, if you're more comfortable, which I am, then I think of the straddle as $3. $3.18, just because I'm not used to looking at straddles that are $535. I do the same thing when I'm looking at stocks that are $2 or $3. In my own mind, I'll make them $20 or $30 because that's how I want to look. Sometimes people look at a $2 stock and 20 cents doesn't feel like such a big move, but then, if we make it $20, $2 is a big move. So that's just a little trick that I use to when I'm looking at really high-priced stocks or really low-priced stocks. But I hope everybody can see just the difference in volatility between these two names, and therefore the difference in straddles, and the difference between the straddle prices.